Welcome to the video, everyone. Today, we're going to be talking about a stock that I believe is one of the best dividend stocks you can get. And you get a sweet 9% dividend yield. That is typically unheard of for most companies, as you're usually closer to the 3% range on your average dividend yield. And this company we're talking about is none other than Rio Tinto. Now let's just take a little look at Rio Tinto's balance sheet just to make sure it meets our standards. Typically, we want to see a stock be under 20 for the PE ratio. Rio Tinto is 6.4. That's a check so far. We also want to see that their revenue is steadily growing. That's a check. We also want to see that their free cash flow is growing. Also a check. Now here's some of the most important things that you can go over when it comes to a dividend stock to make sure that it's safe. You want to make sure that the company can afford their long-term debt as well as afford the dividend that they're paying. First, we'll go ahead and look at the debt. Now, typically I like to see if they can afford their long-term liabilities by looking at the last year of their free cash flow, $17 billion, multiplying that by 3, which would be $54 billion. So we want to make sure that within a 3-year period, they don't have long-term liabilities that are bigger than $54 billion. Yeah, well, their long-term liabilities are $13.4 billion. They can afford all this debt with just last year's free cash flow alone. Last but not least, we want to see if they are affording the dividend. Now remember, dividends are paid out from free cash flow. So we want to see what percent of their money is being spent on dividends based on free cash flow. And there's a handy little number that represents this called the payout ratio. Again, as just explained, the payout ratio will show us what percent of the free cash flow is being paid towards the dividend. Now, typically any payout ratio, 60% or under, is seen as relatively safe, but once you hit around 40% or under, that is seen as very, very safe. Well, Rio Tinto's payout ratio is currently at 40.27%, so that is a really safe, good payout ratio. So it looks like Rio Tinto's balance sheet checks out. They can also afford all their long-term debt, and they have a low payout ratio. Not to mention the sweet 9% dividend, which is why we are here. The balance sheet on Rio Tinto suggests that this is a no-brainer. Now, this isn't really much of a big deal, but I figure it's worth mentioning. Rio Tinto's price action has been a little volatile, so if that's something that bothers you, that is certainly something to consider. It's certainly not as volatile as a lot of stocks in this market right now, but compared to your average dividend that's closer to 3%, there's definitely a little more volatility. If you are a dividend investor, though, this probably isn't going to bother you very much, and a lot of dividend investors are actually just there trying to live off their dividends. So a strong balance sheet and a 9%, actually 9.3% for Rio Tinto is really, really strong. Again, the balance sheet suggests that this is a no-brainer for a dividend investment. And that's going to wrap up the video. If you enjoyed the video and feel that it added value to your day, show some love by giving a thumbs up and subscribe. Have a great day, and I'll see you in the next one.